If a traditional lender told you no, or you've been avoiding applying for a mortgage because you assumed your income wouldn't qualify, this video is made for you. Because here's the truth. The way Americans earn money has changed, but traditional mortgage guidelines haven't kept up. Non-QM loans exist specifically for borrowers who don't fit inside FHA, VA, USDA, or conventional rules. Self-employed, real estate investors, 1099 earners, foreign nationals, borrowers recovering from bankruptcy, high income with heavy tax write-off. If that sounds like you, stay with me. By the end of this video, you'll understand why major non-QM loan programs are available nationally and which ones fit your situation. Hi, I'm John Thomas, loan officer of Prime Residential Mortgage, and I structure non-QM financing nationwide. This is your complete guide to non-qualified mortgage loans. Let's start with the basics. What is a non-QM loan? A qualified mortgage or QM loan follows strict federal guidelines set by the Consumer Financial Protection Bureau. That usually means W-2 income, full tax returns, strict debt to income caps, agency eligible property types. QM loans are typically sold to Fannie Mae, Freddie Mac, or Ginnie Mae. A non-QM loan does not meet those specific standards, but this is important. Non-QM does not mean risky. Non-QM does not mean predatory. Non-QM does not mean no documentation. Every non-QM loan today must meet federal ability to repay laws, standards under Dodd-Frank. Borrowers are fully underwritten. The difference is how income is documented. That flexibility is what makes these programs possible. Non-QM versus traditional mortgages. Here's the simple breakdown. Traditional QM loans have strict DTI limits, require full documentation of income with tax returns, W-2 pay stubs, longer wait periods after bankruptcy and foreclosure, agency property restrictions, and you cannot close in an LLC. Non-QM loans, bank statements are accepted for income, 1099 forms, P&L forms, rental income through DSCR, asset qualification, LLC ownership, very short seasoning on credit events, even 1 day out of foreclosure. Rates are typically slightly higher, but that's the trade-off for flexibility. Who uses non-QM loans? These programs are commonly used by self-employed business owners, independent contractors, real estate investors, fix and flip investors, builders, foreign nationals, ITIN borrowers, borrowers with recent bankruptcy, foreclosures, or mortgage rates, retirees qualifying on assets only, buyers of non-warrantable condos. When most banks say no, this is where solutions exist. DSCR loans, investor cash flow loans. DSCR stands for debt service coverage ratio. These loans qualify investors based on rental income, not personal income, not tax returns, not W-2s, not pay stub. The property qualifies itself. The formula is monthly rent divided by your monthly housing payment. If the ratio is 1.0 or higher, the property covers itself. Program highlights up to 85% LTV, credit score starting at 600, LLC ownership allowed, loan amounts up to $5 million. No limit on the number of properties you can own. Interest-only options. If you're scaling a portfolio, DSCR is often the most powerful tool. Bank statement loans for self-employed. Bank statement loans use 12 or 24 months of deposits instead of tax returns. This is the most common non-QM program for business owners. Instead of adjusted gross income from tax returns, we just simply analyze your deposits and average them over a time period. Example, restaurant owner deposits $25,000 per month. Tax return shows only $60,000 after write-offs. Using bank statements, qualifying income may be $150,000. That changes everything. 1099 loans. These are designed for independent contractors. Instead of using tax returns, we use your gross 1099 income. If you earn $200,000 in commissions, but wrote it down to $85,000 on your return, a 1099 loan may qualify you at $200,000. That's a massive difference. Profit and loss loans. This allows qualification to use a CPA prepared P&L statement. No tax returns, no bank statements. Best for complex business structures, multiple LLC owners, and highly variable revenue. Only 1 year self-employed required in most cases. Asset qualifier loans. No job, no income, but significant assets. This program qualifies you based on your liquid assets. The lender takes your total eligible assets, subtracts down payment and closing costs that you might have to spend out of the asset, and divides the remaining balance by the loan term. That monthly number becomes your qualifying income. Sometimes we divide it by 60 months. So excellent for retirees and high net worth borrowers. VOE only loans for W-2 employees. Instead of tax returns, income is verified directly with an employer. No pay stubs. Useful when tax returns show large rental losses. Deduct reduces conventional qualifying income. ITIN loans for borrowers without Social Security numbers. ITIN in place of your Social Security number. Alternate credit accepted. 10 to 20% down payment typical. These programs create homeownership access for tax-paying residents. Fresh start loans, post-bankruptcy, foreclosure, short sale. This is one of the most misunderstood categories. We can lend on 1 day out of bankruptcy, 1 day out of foreclosure, 1 day out of short sale. Short sale, no mandatory waiting period. Trade-offs, you're going to need a higher down payment, 20 to 30%. You're going to have a higher rate. We're going to need stronger reserves. The waiting period is eliminated. Foreign national loans designed for non-U.S. citizens who want to purchase in the United States. No U.S. credit required. Foreign income accepted. 25 to 30% down typical, available for investment properties only. Fix and flip hard money loans. Short-term financing for rehab investors. 12-month interest only, up to 90% purchase, up to 80% ARV. Fast closings built for speed. Ground-up construction loans for builders and investors. Up to 85% total project cost, interest only during the construction. No income documentation required. Spec and build to rent supported. Non-QM second mortgages. Access equity without refinancing your low first rate mortgage. Perfect for investors, business owners, homeowners with very low rates that want to preserve that rate. Tenancy and common or TIC loans for co-buyers where each owner gets their own mortgage, owns their own fractional percentage of the property. Perfect individual for high-cost markets and multi-unit properties. Are non-QM loans safe? Yes. Every non-QM loan must comply with the ability to pay rules by the Dodd-Frank bill. They're fully underwritten. The difference is the documentation structure, not the underwriting. When does non-QM make sense? If tax returns understate your income because of write-offs, you're self-employed, you're scaling your rental business, you had a recent credit event, you're a foreign national, you're asset rich but income light, you're buying unique property types, then non-QM deserves serious consideration. How does the process work? Step 1, schedule a consultation with me. Step 2, identify your best program, gather your documentation, submit your application, underwriting, 24 hours, close in 30 days or less. Hard money can close even faster, 2 weeks. Construction may take longer due to plan review, obviously, right? If a traditional lender has told you no, or you've assumed you don't qualify, don't self-disqualify. Non-QM lending exists for a reason. Call me directly, 302-703-0727, and let's schedule a structured consultation. We'll review your income, your documentation options, your credit profile, your property eligibility, your investor strategy, your exit planning. Non-QM is not about bypassing guidelines. It's about structuring financing correctly. If your income doesn't fit the traditional box, this is likely a solution out there. Let's build it the right way. I'll see you in the next video.